Good morning and welcome to another episode of Trade with Conviction. I'm your host, Neil Crosby, and today I'm joined by Michael Ryan, our freight expert. Good morning, Michael.
Good morning.
How's it going?
Good, thank you.
Good stuff. And we also have June. How are you, June?
Hi everyone. Still surviving. This is like the 7th week.
Week 7 feels like month 7.
Yep.
Good stuff. Well, why don't we basically start off and bring ourselves up to date basically with where we were from the last pod. And obviously last pod, we were facing a weekend of peace talks. And I guess maybe not inevitably, but perhaps unsurprisingly, the peace talks didn't go anywhere. And the next result of that was that the US declared a blockade of the Strait of Hormuz, particularly with regards to Iranian vessels and any vessels seemingly paying a toll to the IRGC. My impression, you guys can jump in if you like, was that there was a lot of conflicting information over the last 72 hours regarding which ships may or may not be getting through. So there were Iranian vessels that managed to leave the strait and then were turned back. And last night there were sort of Iranian-owned vessels that left, I think, Fujairah and managed to get into the Gulf. So I think there's a lot of misinformation about what this blockade is actually doing. Is that perhaps a fair assessment from your guys' perspective?
Yeah, although I think in the last maybe 36 hours or so, it seems to be cleared up a little bit in that the focus is on ships leaving or going to Iranian ports. I have seen it was the Tuesday count that 5 ships left the Strait of Hormuz, tankers, that is, and 1 entered. So it seems like we're starting to get a little bit more clarity, but you're 100% right that it's still very difficult to act on this as a ship owner because you still just don't know what's going to happen. And you don't have the communication channels that you used to have.
And there's been less attacks on ships, right? Because that's one of the things we talked about over the last 7 weeks, June, was every few days you get a flurry of attacks on tankers. And that seems to have gone away as well, if I haven't seen anything about it. Does that
Probably
give
the
owners some
ceasefire
more
effect?
confidence? Well, yeah, of course. But it's the ceasefire effect. But does it give owners confidence, or is it more a kind of, okay, we have to wait and see what's happening to the toll booth and things like that?
I think it gives owners confidence, but still not enough to really transit without the safety lane in place, the US confirming 100% that there's no mines, etc. But confidence is building. It just feels like with the ceasefire holding, general de-escalation, the continued rumors of talks, that confidence is building.
Yeah. At the same time, you've got one thing I noticed on Twitter and stuff was more and more attention to basically US military buildup, which is ongoing. So it seems like another thing where they're positioning for talks, but also positioning for a re-escalation should it be necessary, or maybe that's the intention all along. I don't think we're going to be party to that information, but it seems both options seem possible at this point in time still.
Yeah, it does. And it could just be a third simple one where it could just be repositioning. And it could be positioning that we, US military, have our fleet here, and it's just pressure to keep the talks ongoing and the ceasefire in place.
Yeah.
Hopefully.
So clear as mud as it's been all along. And there's various prices that we can look at, that obviously the main one being crude futures, that currently say to the market, this thing is not over, but as you described, Michael, it's definitely a kind of risk-off week. And I want to quote Javier Blas, just because, not to pass any judgment on this, but he tweeted, I think last night, that the energy crisis is effectively over in Europe. And he's probably talking about all kinds of things, including natural gas. But from our perspective, and there maybe I would pass to you again, June, from our perspective, even were peace to come into play next week, we've still got months ahead of us of massive supply chain issues, right?
Yeah, I mean, the market needs to realize that the supply chain is fractured. If we need to rebuild, we need to reinventarize, we need to resume logistics the way it is in order for the markets to be back to where it was. And that would take like 3 to 6 months from what we've laid out in terms of our likely action plan. from all the different players in the market. And I think now on top of that, we know that so many of the VLCCs have headed to US Gulf Coast. You need to reposition those vessels back into the Middle East to take away cargoes as well. All this takes time.
All takes time. So it speaks for continued divergence or even more divergence between, let's say that peace was called, you're going to get more sell-off in crude futures. But in terms of the product market, the situation might even get worse from an actual physical supply perspective before it gets better. Whether or not that plays out in something like diesel spreads is a different story, but in terms of the crack, it might be something to think about going forward in that scenario. I just want to go back to a couple of basic things. So one of the themes we've had over the last 7 weeks has been this notion of West versus Eastern balances. And one of the things we picked up on in our comms this week was the big sell-off in both gasoline and diesel east-wests. That means the Singapore market sold off against the European market. That's maybe counter to what we might have thought would happen, or maybe what we think will happen on average. June, do you want to kind of take us through some of the bits and bobs here? So, for example, what's happened on observable runs so far in Asia?
Okay, for Asia, I mean, we know that the runs are at risk, increasingly at risk, particularly in OECD Asia and Southeast Asia. The most transparent data out there is from PAJ, and Japan data is showing 68% utilization rate versus the design capacity and 76% against operable capacity. This is versus probably the 80% or higher numbers prior to the crisis. Note that Japan has already released 53 million barrels out of the planned 80 million barrels of SPR release to help support maintain these runs. And I think for the rest of Southeast Asia, especially Singapore, we also have information that the runs are at 50 to 60%. So it's at kind of like the very low end of runs already, but not super low across all countries here.
Yeah, so the main one being China, right? So what's happened to Chinese runs and how are they getting around, let's say, the new lack of crude in the market?
China has also reduced intake, but it's probably not as extreme as what we are seeing in Japan right now. They are starting to tap more and more into their SPR. At the beginning part, they were very hesitant to do it, but last week there was already announcement that they are going to get some access, at least from the state-owned refineries, state-owned enterprises refineries. And there was an interesting fact that there was a cargo of crude that was moved from China tanks into Singapore. There is a JV here for PetroChina in our refinery here. So it sounds like increasingly a desperate move to keep refineries in Singapore running. And also for those in Singapore, there was this grand show of the Singapore Jurong Cavern caves in media last couple of days by the government trying to kind of allay fears that we have reserves, but actually there is no crude stored in those caverns. So we have no SPR.
June, can I ask a question? For Japan, what would be the best replacement crude? Which crude grade, which region?
Yeah, Japan is a medium sour crude configuration. They do they need the Arab medium kind of base design, which therefore is a Mars quality.
Okay.
From the US Gulf Coast. There are runs that they take Arab extra light and Morabun as well, so that can be replaced by WTI. But the vast majority of the medium sour crude is very likely difficult to replace directly just from Mars volume alone.
Yeah, true. And Mars, if you're going to want to take it on a VLCC, it's going to be a very long haul voyage from the US Gulf Coast to Japan. So all of that makes sense.
Neil, what do you see on Europe side on the runs?
Yeah, just to say on Mars as well. I mean, there's not enough Mars in the world to replace what's been lost, obviously, which is why also TI has just been a massive draw on TI from Asia. One of the things that I think the Japanese have been doing so far is blending WTI with some of the heavy crude in their SPR. So that has been manageable so far, but whether that can continue long term is a different kind of question. Yeah, I just wanted to back that up with, it probably makes sense to us that there are some temporary weaknesses in the Asian pricing side of things, because from my perspective, if it turns out that run cuts in Asia have not been maximized this month, that might make sense because we're drawing down on SPR, we're drawing down on oil and water, we're drawing down on commercial inventory. The question is, how does that go on, right? So highly likely if this thing continues, run cuts in Asia will simply increase, and they will increase. They'll probably double in the next couple of months. They might even triple in the next couple of months, which means that the kind of Singapore swap pricing on diesel, gasoline is likely to kind of reignite, and that will provide more signals to get more clean products from the west to the east at times. On the European side, there's something interesting happening. There was quite a bearish dated window yesterday. We've been talking about that for a few days. In Europe, margins are basically telling the Europeans to not run as hard. They're telling the Europeans to cut runs. And that might not be super strong in the next couple of weeks, but if it continues, European refineries will also be slightly at risk. And that only puts more onus on getting US oil out of US tank and into places like Europe and Asia. And I wanted to just kind of pick your brain there as well, Michael, in terms of what have you been seeing on particularly clean? I mean, we've seen very strong signals on dirty, but particularly clean products out of the US Gulf into the world, basically.
Yeah, so across the regions that you were just talking about, so Southeast Asia and Europe, there's been a bit of a divide in price action on MR rates. So there's been a lot of demand out of Singapore and Southeast Asia from Australia to carry products on MRs. And there's been reports that there's been a few more cargoes than normal available out of Singapore, and these have been fixed pretty quickly at higher than last done levels, mainly into Oz business. And then for Northwest Europe, over the last 10 days, there's been a material drop in the number of fixtures, and especially for long haul fixtures. So over the last week or so, I haven't seen any long haul Northwest Europe MRs indicating Australia or East Africa or Japan. What I've been seeing are a lot more short haul voyages, either Europe to Med, cross Med, or just a very quick sort of like UKC, intra UKC. And with Singapore rates moving higher, it's making the European price action look even worse. European rates have moved sideways, but I think just also given what you're saying in regards to kind of the potential for a cut in run rates at refineries, I think we're going to start to see a little bit more pressure on TC2 rates.
Okay,
now, so US Gulf Coast, I'm still supportive. I'm getting maybe a little bit concerned in the medium term if we start to see significant stock draws. But for right now, there's still elevated fixture activity. You're still seeing Jones Act activity. You're seeing routes globally. The US Gulf Coast continues to be the de facto source of product supply.
Yeah, that makes sense. I think in terms of oil stock draws from the US, it took a long time to see anything. And basically last night's data set was the first one where you really started to see the impact with very high crude exports and very high product exports out of the US and slightly low run rates as well, which was interesting. But I agree with what you say. Basically, the draw on the US oil will continue until such time as the stocks there get too low, at which point things like the HOGO will start to defend US inventory because that's simply what's needed, right? So more flow to come. All right, back to a couple more basics. Maybe we can fly through this, June. There's a couple of things, larger stories. One is demand, and there's been a lot of questions on demand destruction. What are you seeing there? Are we seeing more signs of demand destruction faster than expected?
Well, we've seen IEA adjusting their 2026 demand growth forecast already to negative versus 25 of yesterday. On the jet fuel side, European airlines are warning of major shortages by May. Another interesting bit that I picked out is also about flight optimization. We talked about flight cancellation, but now flight optimization. We've seen China cutting flights to Australia, but replacing it with more European flights. And interestingly, the reason why is because they can fly over Russian airspace and slash fuel burn. There's also a capacity shifted towards Asia to capture displaced transit demand that would have otherwise routed via Middle East. For other kinds of demand destruction plays, we have Australia launching the Every Little Bit Helps campaign for reducing fuel demand. EU president has been quoted saying the cheapest energy is the one you don't use, so implying stay at home. And work from home policies are already in effect for many import dependent countries like Malaysia, not so much import dependent but still affected. So Malaysia, Laos, Myanmar, Thailand, Vietnam, Pakistan, Philippines, even as far flung as Peru.
Yeah, that's interesting, and that's the type of thing that hasn't been seen in the West yet, right? It's been very much targeted in in countries that perhaps have a bit more scope to do so. Can you imagine? Think back to the protests when there were COVID lockdowns. It's definitely a kind of Western feature that there's a lot of public backlash to that type of thing. But it might come, but it makes sense that demand destruction has probably been faster in the East than it has in the West up to this point. And probably again explains part of the weakness in Singapore pricing at this point in time. And also, as you point out, June, what's not helping demand destruction in the West is things like fuel price caps, cutting fuel taxes. All these things basically are making the problem worse from a balance perspective, let's say. What about refining? So I think you have some ideas about second round effects, about low rates of utilization, June?
Yeah, so we talk about refining, and usually we just put the head of CDU, the crude distillation unit, being at min-intake. But what we don't realize is it's also applicable to all the secondary units. And the secondary units get their feed from the bottom of the CDU, the fuel oil portion. This fuel oil, the straight run fuel oil, is split into two things. One is the VGO, the lighter fraction of the fuel oil, and the second part is the short residue, the heavier fraction. So the VGO can go into the hydrocracker to produce more middle distillates, the FCCs to produce more mogas or base oil production. And the short residue can go into the cokers, the visc breakers, thermal gas oil units to basically produce again more middle distillates. And also it can go to bitumen production. So let's go back and do some mass balance here. We have lower medium sour crude availability. It means we have lower production of VGO and SR and short residue. So therefore, there's hard choices to make in terms of how these flows are routed within the refineries to keep each secondary unit at mean feasible intakes as well. So on the VGO portion, you got middle distillate cracks shooting to the roof. The refineries will then want to prioritize running that VGO into hydrocrackers. Then you have FCCs for more gas production. Base oil will be the first to get kicked out. And we've seen that already in Singapore. At the same time, we reach the point where we run out of feed even for either hydrocracker and cat cracker. Then the hydrocracker will get priority. And at that point of time, weaker more gas cracks versus gas oil will need to respond.
Yeah, so does that also mean, as a follow-up, that if we're going to have a global system that's running on lighter slates, what you're saying means the VGO that is available gets pushed to hydrocracking, and there's even less FCC operations, and that's even less gasoline production even. Is that a fair statement as well from the slate perspective?
Yes, at the margin, we should therefore see more diesel being produced versus gasoline. But of course, the demand is the picture here, right? Where the demand for diesel is really difficult to meet right now.
Yeah. What about short residue, low sulfur fuel oil?
Again, we want the refineries we want to maximize margins from and making more distillates from the short residue. So you route first to the cokers, to the visc breakers, to the TGUs, and bitumen is again the first to be kicked out. So 2 out of 3 refineries in Singapore have already declared force majeure on bitumen production. And all of this also means you're going to get less high sulfur fuel oil production because your short residue is being used in the secondary units rather than in the fuel oil blending pool. And on the VLSFO side, you should be looking at the LRCCU, long residue cat cracker. The amount of low sulfur streams we already have is already a lot lower than due to the massive run cuts everywhere. And then you have less. You want to keep the LRCCUs running at min intake, you will then produce less VLSFO. All this basically points to the fact, to our view, that the Singapore bunker fuel production will be significantly lower and the current Q3 cracks are actually undervalued.
Yeah, lots of things undervalued. Good.
Singapore is a huge bunkering hub. I mean, globally, it's so important.
Let's move to the physical market then. So crude, what are we seeing on the crude pricing side of things?
Dubai side, it has been quite subdued. It's very poor liquidity, and we versus last month where we saw fireworks with Totsa. Melbourne is now at June Dubai plus $13 per barrel compared to where it was last month, about $50 per barrel premium. And increasingly, more AG grades are being traded on dated or ICE Brent basis. For example, from the IOC recent tender, it's definitely a trend showing that people are losing confidence on the Dubai as a benchmark. On the buying side, Korean, Japanese buyers are stepping up WTI very early in the trade window compared to previous months. WTI still remains the cheapest ARB crude into the Far East, but that gap, the value gap, has narrowed with Melbourne prices coming off already. But still, I think right now it's just about availability. China has not touched WTI. It still has the 10% tariff on it. It prefers to load up on Brazilian and Guyanan crude instead. They have been allocated less than half of their Saudi crude volumes for May, and perhaps indicating a diversification from the Middle East with Yanbu loadings still at risk from any potential attacks from the Houthis.
Yeah, I was just want to follow that up and say, of course, the unsurprising trend about places like China, also Japan, is that the preliminary import statistics are showing that they're simply importing less crude. And that is just unsurprising, right? There isn't enough crude around. I haven't seen, for example, massive or unusually high flows of dated linked European crude going to Asia. Obviously, there's an exception on TI. TI has been very much in demand. But the problem is that there isn't enough crude in the world to fill what's missing in Asia. Europeans look to have been bidding quite hard for their own crude. So it's not something that's sustainable in terms of China can just buy up all the Brazilian, all the TI, all Guyana that it really needs. It's also going to have to draw from inventory, which is an obvious statement, but it's what's actually playing out too.
But Neil, it's also important to note what you said there. It's actually bearish DPP freight rates to a certain point, just because if there's not enough crude that can be exported on the water, we're gonna have idle tankers eventually. And there's been a lot of news over the last week, just all of a sudden, about all of these tankers heading to the US Gulf Coast. It's not like these tankers just started heading there a week ago. They've been moving there for over 6 weeks or so now. But you made a really good point in that if there's not enough crude to satiate the demand in the east and the crude is coming out of tanks, well, then what are all of these tankers going to do when they hit the US Gulf Coast? There's only going to be so many loadings.
Yeah, and there's also port capacity limits to think about, right? I think we already hit, I have to check again, 5 million barrels per day of crude exports out the US. I don't think the US can do 6. So even if there was more demand than that, simply limits to infrastructure.
Exactly.
What about India, June? What's the Indian story?
India has the luxury of taking as much Iranian crude as they can, but before the Iranian oil waiver expires this weekend, they have also been taking a lot of Russian crude. It's pretty much back in their base diet right now, but at a higher price versus pre-crisis. But having said that, it helps that Reliance therefore has access to this and still supplying marginal products out into the market.
That makes sense.
West Coast
So
India,
Sorry.
I was just going to say, continues to supply the world. Like, we're still seeing fixtures into far-flung places. So typically you see a lot of West Coast India product barrels into Africa. But as we continue to see that, we see it into Southeast Asia, Australia, the US, really everywhere.
Good stuff on the Michael. Have you got any other thoughts about? Because I think I read a little idea from yourself on the kind of peace scenario on TD3. Do you want to talk us through that one?
Yeah. So when I talk to people in the freight market, I feel like the market's a little bit complacent, and they're thinking that, okay, we made the right decision to ballast our V or our Suezmax from the AG to the US Gulf Coast. And although I agree that that is likely the right decision, but it was very much more the right decision a month ago. And now, if we just push forward and look ahead, if the de-escalation continues at the pace that it currently is, and we either get a deal or we get proven logistics of transits through the strait, and in effect, the strait starts to reopen, I think at first you're going to see a very violent sell-off in AG paper, and that's TD3, that's TC5, so across DPP and CPP. But what I haven't heard anyone talking about lately is just the fleets have repositioned themselves away from the AG. So in June, I can get your input on this, but depending on the ramp-up times for getting crude running again, there might be weeks-long gaps of when there are not enough DPP vessels to actually load that crude out of the AG. And I think that's this timing issue that could cause your AG freight rates to move back higher. So after that initial dip, people reprice, and then over, say, the coming month, everyone realizes that there's not enough vessel supply in the region, and you start to see rates reprice again.
I think from the crude production standpoint, Kuwait is probably the most pessimistic in terms of startup time, which is they mentioned 3 months to start up.
Okay.
But the rest of the production shut-in, I think, might take faster than that. So between 1 to 2 months. Hopefully that time will allow already the vessels to come back.
Yeah, I would say you could kind of assume 6 weeks takes a bit for owners to decide to actually make the trip. They need confidence that once they get there, they're going to be able to load, so they're not going to turn around immediately. So add a couple weeks on. So 6 weeks, and then basis the timelines you just said, 1 to 2 months. In theory, you could see some alignment of when the tankers start to arrive and when production really ramps back up. But if there is a dislocation on the timing, that's what I think can cause a rally again in your AG freight.
Yeah, and you also have to remember that the issue is tank tops, right? And we've been over this before, where you need to clear some of the tanks in order to start the process of restarting. It's maybe not completely simultaneous, but you could probably front run it a little bit. But first you have to have surety that you're going to be able to clear these tank tops, because if you start to restart and you've got nowhere to put the oil, it's a problem. All right, let's look at middle distillates and light distillates. June, do you want to take us away with a bit more detail about what's happening in Singapore diesel?
Yeah, we saw East-West diesel at a 3-week low, which seems surprising for many people. Right at the start of the conflict, some traders immediately booked cargoes from Europe and the US, and many of these are arriving this month in April. South Korean sellers have resumed spot sales. The government has pledged not to impose an export ban, so keeping regional buyers reassured, not rushing to hoard cargoes. China has been exporting some cargoes to developing country allies via government-to-government deals, although as per original, they said they are going to have an export ban. And with all this demand destruction and hand-to-mouth buying in most of these regions, overall demand has become much more restrained than we first thought. The most urgent demand has now been covered. Buyers are now more selective. They have been flagging the steep backwardation across products as a major issue. And they argue if they can't clear the cargoes within April, they will face significant losses selling downstream on a May basis. So while some are asking for big discounts for the remaining April cargoes to reflect the steep backwardation, others are preferring to defer May cargoes to May for same downstream deliveries.
Yeah, it's interesting because that plays into what we've been talking about, right? We've got this flurry of cargoes. Demand destruction has probably been high. Run cuts is probably not maxed out yet. It can probably reverse next month when run cuts get worse, but the timing's probably extremely difficult. I mean, there's lots of people who have been burned by these kinds of notions over the last few weeks. And just on the ARB side, I can still see Houston arbing to Singapore now relatively effectively. And you've got the North Asian ARBs into Singapore open. You've got West Coast India barrels open to Singapore. So just on the ARB basis, it doesn't look like a great time to be long east-west, but I still think it can turn around in maybe May, for example.
So June, just from a freight perspective then, it sounds like part of the reason we're seeing few to several extra cargoes available to load out of the Singapore region and into Australia, is that because of the Southeast Asia demand destruction?
Partly, and also because probably there was overbuying at the start of the conflict as well.
Yeah, okay. Makes sense.
The underlying fundamentals are quite clear though, right? We're missing a massive chunk of oil. So unless demand destruction is ultimately already bigger than it needs to be, this thing will rebound a little bit. On the HOGO, there's just one little segment on the HOGO. So it kind of did what we were talking about. It tended to rally whenever there was a sort of de-risking tweet or headline. And we've been saying for the last couple of weeks, it probably needs to be relatively narrow so as to open up the Gulf Coast ARBs to all kinds of places. We actually saw New York to Rotterdam open for a brief spell. I have to check if it's still open. So it tended to work, but we did start to see larger draws in US distillate last night, including in Pad 1. And eventually, I think maybe within the space of 1 to 2 weeks, this thing can start to turn around where another couple of draws in Pad 1 means the interest in the HOGO, in going long HOGO, starts to rally. And then we'll be talking about a change in ARB economics as well on the freight side, Michael, perhaps as early as May, I think.
Okay.
Light distillates, June, what's happening on Singapore Sing 92 cracks?
Yeah, yesterday there was a big drop in the Sing 92 cracks, and while the cracks in the Atlantic Basin woke up and rallied to year-to-date highs. So Sing 92 has been feeling the same impact as diesel in the region. The supply shock is yet to materialize fully, while demand destruction is already in place. The relative collapse in the May East-West, which is now back at parity after trading at plus 12 just a week ago, is reflective of this lack of urgency to bring further Atlantic Basin cargoes into Asia for now. What this means is that the market is still pricing European resupply for South and East Africa, but loses Pakistan and even Yanbu outlets if forward pricing remains at current levels. I'll just add a little bit more about the news story where Australia's Geelong refinery, 120 kbd, suffered a fire this morning. Fire this morning at the alkylation unit. That should add some strength to the zinc 95, 92 spreads, because they lose some high octane components there.
Yeah, and on the EPOB side, there has been a bit of relative crack strength. To a certain extent, it feels like a natural reaction to the strength of European crude. So are we really in a position where we want European refineries to be permanently this bad in terms of margins? But on the ARB side, we have also seen some barrels moving TA. So mostly components, presumably not RBOB. And up to now, a comparatively weak TC2 has been allowing ARA to capture a bit more of the kind of LATAM outlets and even the Canada outlets. So it looks somewhat supportive on the ARB side for EBOB as well. The thing about the US is that we finally saw a properly meaningful draw in Pad 3 inventories, so probably higher than expected, bases our expectations in the team. Pad 1 imports have been very low, but inventories there are still relatively comfortable. So, we're not too concerned on that basis yet, but the tightness we've seen in Gulf Coast components does seem real, even if you get a bit of extra yield in terms of the spec waivers that we've been seeing over the last couple of weeks. So overall, we don't have huge panic stations from Atlantic Basin gasoline yet, but we're starting to see draws in earnest, and possibly it's only another couple of big draws before interest in being long cracks starts to rise. And of course, we're heading into a summer season where we've got lighter crude slates, massive run cuts, and, a focus on diesel yield. And I think there's still a lot of interest from the analyst side of things to be long either summer cracks or from a gasoline diesel spread perspective as well. Just noting that the EBOB ULSD spread for June is minus $80 per ton still. So we'll figure out we'll see in time whether that really makes sense or not. All right. Anybody got anything else? Should I leave it there?
No, I think we covered a lot.
It's already pretty long. Okay. All right. That's it, guys. Thanks very much for listening again. And thank you to our two presenters, Michael and June. And good luck with your trading. We'll see you next week.
Thanks, Neil.
Thank you.
Cheers.